Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know. First, UK Conservatives unveil a £47 billion spending cut plan, sparking a fiscal credibility race that puts the gilt market on edge. So we'll discuss why this gambit forces the opposition's hand on spending and what it means for UK borrowing costs and the pound. Second, US shutdown hits contract workers without back pay, creating a shadow labour shock that could mislead the Federal Reserve. We'll examine how these uncounted job losses could distort economic data, potentially impacting the Federal Reserve's interest rate decisions. Third, a new US tax law overhauls small business deductions, incentivising domestic R&D and fueling a potential capital expenditure cliff. In this episode, we'll break down how these changes rewrite the rules for business investment and what it signals for inflation and US competitiveness. The most unexpected news in the finance world today has to be the Conservative Party's bombshell proposal to slash public spending by £47 billion over the next 5 years. Now, this isn't just a random number. It's a strategic move designed to start what some analysts are calling a fiscal credibility race. The goal is to force the opposition Labor Party to reveal their own, possibly unpopular, spending plans. The Conservatives are essentially creating a political test, and the financial markets, especially the UK government bond market known as gilts, will be the judge. If the markets don't believe either party has a credible plan, the UK's borrowing costs could rise. The plan targets three core areas. First, a dramatic overhaul of the welfare system, including a proposal to stop cash claims for what it calls low-level mental health problems, arguing that treatment and support are needed, not payments. Now, get this, it's a high-stakes bet on boosting the UK's labour supply. The goal is to reduce what economists call the economic inactivity rate. That's the share of working-age people who are neither employed nor looking for a job. A major reason for the UK's rising inactivity rate since the pandemic has been long-term sickness. The success of this policy, however, depends entirely on whether the already strained National Health Service, the NHS, has the capacity to provide the necessary treatment and support. It's a huge implementation risk. Second, a massive reduction in the size of government itself, cutting 132,000 civil servant jobs, a reduction of roughly 1/4, and the economic impact here could be much larger than the direct savings. It all comes down to a key concept, the fiscal multiplier. Research from the UK's own Office for Budget Responsibility estimates that the multiplier for public sector job cuts is around 1.5. This means for every £1 saved by cutting these jobs, the country's GDP could shrink by £1.50. The loss in productivity and consumer spending from these job cuts, especially in regions with high public sector employment, could end up hurting the economy more than helping the budget. However, if you zoom out, you'll see another layer of strategy at play. The plan also calls for slashing foreign aid spending by £7 billion, taking it down to just 0.1% of national income. This is significant because it signals a major retreat from the UK's global Britain ambition. This spending, officially called Official Development Assistance or ODA, is a key tool of international soft power. By cutting it so drastically, the UK creates a vacuum, ceding strategic opportunities in developing nations to rivals. For example, China has been expanding its global influence through its Belt and Road Initiative, funding major infrastructure projects. A UK retreat could undermine its long-term diplomatic and trade relationships as countries may increasingly look elsewhere for partnership and support. The move was immediately labelled reckless, short-sighted and morally indefensible by one international development network. The party's Work and Pensions Secretary, Sir Mel Stride, put it bluntly, stating there is no more pretending we can keep spending money we simply do not have, but critics are already firing back. One economic think tank warned the plan ignores the elephant in the room of age-related spending like pensions, which remains protected by the triple lock. So what makes that elephant so large? It's the triple lock, a UK policy that guarantees the state pension increases each year by the highest of three measures: inflation, average wage growth, or 2.5%. This protection is causing age-related spending to soar. Projections show it rising from 23% of the UK's economy in 2025 to over 26% by 2065. By comparison, France, which has undertaken painful pension reforms, expects its age-related spending to actually fall over the same period. So by protecting pensions, the government is forced to make much deeper, more economically painful cuts to other public services and investments. This all sets the stage for an immense political showdown. The opposition Labor government now faces a critical choice. With Chancellor Rachel Reeves heading into the November budget with what the Office for Budget Responsibility calls a very small margin of just £10 billion, the pressure is on. And that very small margin has a technical name, fiscal headroom. It's the buffer zone the government has between its borrowing targets and its actual borrowing. A £10 billion headroom is considered extremely tight, leaving almost no room to handle unexpected economic shocks without breaking its own fiscal rules. This isn't just a policy debate. It's a fiscal gauntlet thrown down just weeks before the budget, forcing a national confrontation over who will ultimately pay the price for balancing the UK's books. The key things to watch now will be Labor's response and how the UK's bond and currency markets react. Any signs of political deadlock or a lack of credible plans from either side could lead to volatility, potentially raising borrowing costs for the government and impacting the value of the pound sterling. While the UK government debates deep spending cuts, a different kind of government-induced financial shock is hitting the United States. A shutdown is underway, and for thousands of workers, the financial clock is ticking towards zero. One 65-year-old food service contractor, Willie Price, put it bluntly, "I could lose the house, I could lose my car, I could lose everything." A while back, we talked about how household excess savings from the pandemic had largely been drawn down, setting the stage for a sharper consumer hit if income suddenly stopped. Keep that in mind here. It's a heartbreaking situation, and these individual stories are actually the leading edge of a much bigger test of the American consumer's resilience. And here's a crucial detail. This shutdown is happening in a high interest rate environment. Unlike the 2018 shutdown when rates were much lower, today's high borrowing costs mean a sudden loss of income could push many more people into missing loan payments. We'll be watching for a spike in credit delinquencies, which is a key indicator of consumer financial health. If a lot of people start falling behind on their payments, it could signal a slowdown in consumer spending, which is the main engine of the US economy. While many furloughed federal employees are guaranteed back pay once the government reopens, there's a critical detail sending shockwaves through a vulnerable workforce. Hourly contract workers are not, for them, the income is gone permanently. Here's where it gets interesting. The hardship faced by these contract workers creates what economists call a shadow labour shock. When we hear about the health of the job market, we often look at a number called initial jobless claims. But here's the catch. Many of these contract workers may not be consistently counted in that data, as their eligibility for unemployment benefits can vary by state. That means the Federal Reserve could be looking at the employment numbers and getting a misleadingly optimistic picture. They might not see the full extent of the distress, which could affect their decisions on interest rates. We previously analysed how a prolonged shutdown can also trigger a data blackout after the 2013 shutdown. Key inflation and jobs reports were delayed by about 2 weeks, so the risk of a misread only grows if official data go dark. Price, who lives paycheck to paycheck, hasn't worked since the shutdown began, and she is not alone. Audrey Murray, a 64-year-old security officer at the Smithsonian, is facing the shutdown of her paycheck. She supports her 2 sons and granddaughter with a monthly mortgage payment of $2,200 and grocery bills hitting $600. After the last government shutdown in 2018, it took her 2 years to pay off the debt she incurred just to survive. Now, she's facing the same crisis again, asking, how am I going to feed my children and pay my bills? Beyond the immediate human cost, there's a longer-term financial cost to the entire country. You know, this recurring political drama is making investors nervous. There's a financial instrument called a credit default swap, or CDS. Think of it as an insurance policy on a country's debt. The price of that insurance for the US has been rising and is now at levels similar to countries with much lower credit ratings. That's a sign that the perceived risk of US government debt is increasing, partly due to political instability. A while back, we noted that markets usually care far less about shutdowns than about a debt ceiling breach. Shutdowns are operational, defaults are credit events, but with a weaker economy and rising questions about US state capacity abroad. This move in CDS looks less like background noise and more like a warning about credibility and stability. This isn't just a few isolated cases. One union, 32 BJS EIU, represents 2,400 federally contracted security officers, cleaners, and food service workers who now face a financial cliff. The Congressional Budget Office estimates 750,000 federal employees could be put on unpaid leave for each day of the shutdown, with the uncounted number of contractors adding to that total. And remember, the CBO estimated the last major shutdown permanently erased about $3 billion from the economy, evidence of how a sudden stop in household spending can leave lasting scars. Believe it or not, there's another strange, unintended consequence. A shutdown lasting more than a few weeks could create a disinflationary shock. In areas with a lot of government workers, like Washington, D.C., when thousands of people suddenly stop getting paid, they also stop spending money on services like restaurants, haircuts, and so on. This drop in demand can actually push prices down locally. It complicates the Federal Reserve's big fight against inflation. The Fed might see inflation numbers go down and think its policies are working perfectly, when in reality, it's just a temporary side effect of the shutdown. It's like trying to read a map in a storm. The data gets messy. A few days ago, we mentioned that some strategists have been urging investors to treat shutdown worries as a sidebar and even buy dips. Markets might well do that, even as the data get noisier and households bear the pain. As one union president stated, these low-wage workers will bear the brunt of the shutdown. It's a crisis that threatens to turn their lives upside down, forcing many to risk eviction, have their utilities turned off, and leave them unable to feed their families. So, as this situation unfolds, here are a few key things to watch. First, keep an eye on those weekly initial jobless claims. But remember, the shadow labour shock we talked about, the numbers may not tell the whole story. Second, in the coming months, reports on consumer credit delinquencies will be crucial. A rise there would confirm that the financial strain is spreading. Finally, for those interested in the bigger picture, watch the US sovereign CDS spreads. If they continue to stay high, it signals that markets remain worried about America's fiscal stability. And if the shutdown drags long enough to delay key economic releases, a data blackout we've seen before, with roughly 2-week lags in 2013, expect more volatility and a Fed that has to be extra cautious while it waits for clearer signals. These indicators will give us a clearer picture of the true economic damage. Speaking of the government's impact on the economy, while the shutdown is causing widespread pain, a completely different story is unfolding on the legislative front, one that could inject a huge amount of stimulus into Main Street. A massive change to the US tax code is now in effect. The headline number is staggering. Small businesses can now deduct 100% of the cost of new computers, machinery, and equipment, a huge jump from the old 40% deduction, and that's just the start. This policy, known as 100% bonus depreciation, is designed to trigger a massive front-loaded surge in spending. For a small business, this means if they spend $10,000 on a new machine, they can reduce their taxable income by the full $10,000 this year, immediately freeing up cash. This creates a predictable economic pattern, a short-term boost to US GDP, but one that could be followed by what economists call a capital expenditure cliff, where investment suddenly drops after the initial buying spree is over. So the key indicator to watch in the coming months will be durable goods orders to see if this boom has legs or if it's just a short-term sugar rush. This is all thanks to the One Big Beautiful Bill Act signed by US President Donald Trump. While passed over the summer, its full impact is only now being felt on Main Street. But that's not the whole picture. The real turning point is how the bill directly reverses a major provision from the 2017 Tax Cuts and Jobs Act. Previously, businesses had to spread out their research and development expenses over time. Now, they can immediately deduct 100% of domestic R&D costs. One tax director at Baker Tilly called this a huge relief for taxpayers who were negatively impacted by the old rules. The emphasis on the word domestic is crucial here. After all, for years many US firms have offshored R&D to places in Asia and Europe to save costs. This policy aims to reverse that trend. For a Chinese-speaking audience, this is an important signal. It suggests a potential shift where the US actively competes to be the primary hub for high-tech development, which could affect the global distribution of high-skilled jobs and investment. Data from the US Bureau of Economic Analysis already shows a 15% increase in domestic R&D spending by multinationals in the past year, while their foreign R&D spending actually declined. This is where the situation takes a more complex turn. The law also revives a more generous calculation for deducting interest on loans, a critical lifeline for businesses that need debt to grow. So the thing is, the details here are pretty important. The old rule, which took effect in 2022, was much stricter. It limited interest deductions to 30% of a company's earnings times before times interest and taxes, or EBIT. The new law reverts to the pre-2022 standard, which is based on earnings times before times interest, taxes, depreciation, and amortization, or EBITDA. The difference is depreciation and amortization. Because the EBITDA calculation allows you to add those back, it results in a much higher income base, which means businesses can deduct significantly more interest. This is a huge deal for capital-intensive businesses because it will likely fuel more borrowing to fund growth. However, this also increases leverage in a key economic sector, making it more vulnerable if interest rates rise again or if the economy enters a recession. It also makes the popular 20% qualified business income deduction permanent, solidifying a major tax break for sole proprietors, partners, and S corporation shareholders. Interestingly enough, there's also a potential long-term effect on inflation to consider. This deduction, also known as QB, directly boosts the take-home income of many service-providing business owners, from consultants to contractors. By making this tax break permanent, the policy provides a stable, long-term support for their personal income. This, in turn, can strengthen their pricing power. They may be less inclined to lower their prices to attract business. It could create what's known as a sticky floor for core services inflation, making it harder for the Federal Reserve to bring inflation down to its target. This is a crucial point to watch in future CPI reports. Even the much publicised no tax on tips provision comes with a stark warning. While certain business owners can deduct up to $25,000 in tips, one analyst at Grant Thornton cautions that the IRS is expected to apply more scrutiny to those records. From equipment write-offs to R&D, expensing and interest deductions, this isn't just a simple tax cut. It's a structural overhaul designed to let Main Street retain more income, fundamentally rewriting the financial rulebook for small business growth.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.